I want to start with your read on what's going on in the financial markets. We see stocks rallying for a second day. Do you read the recovery in risk assets at the end of March as a tactical shift, or was this the beginning of something more, do you think?
Well, first of all, thanks, Scarlet. It's good to be here and everybody's safe. I'm actually beginning week 5 of sheltering in place, so it almost feels normal. I know that sounds strange to say, but once you start to do it for a while, you kind of get used to it. You get into a rhythm. And I think the markets are the same way. I think, we've probably seen the most exacerbated moves in equity markets that we're going to see in terms of extreme volatility, in part because, the virus was largely an unknown. Like, we didn't know about it, and we didn't know what the impact would be on March 1st of this year. And so when you saw the first really meaningful leg down, it felt like there was no bottom because, frankly, people didn't know what the policy responses were going to be. They didn't have an idea what liquidity was going to look like. And I've said over and over again, I think in times like that, people they look for the most liquid assets to sell so they can have cash in their pocket, and that happened to be equities in the early part of March. The bounce that we saw at the end of March is really a function of the fact that, stocks had fallen so far so fast that there was some technical rebalancing. And now I feel like, we're following the arc of the virus as the primary indicator. And that's, the news we've gotten over the past few days has been, I think, surprisingly upbeat, particularly as it relates to hard-hit areas like New York City. And as a result, the market is saying, okay, maybe this isn't going to be as bad as we thought it was going to be. And we'll see how that plays out. So all kinds of different reasons why equities move, but that's sort of my general sense as to what's happening now.
Yeah, Jeff, Romaine here. So if you're trying to sort of plan out a portfolio or just plan out any sort of dip buying, any sort of valuation plays here, how do you actually model that in this type of environment where even if you have a company that maybe looks good on the surface, when you don't really have that certainty or that clarity as to what the economic fallout or the longevity of this economic fallout is going to be, how do you model that?
Well, so I think people start are starting now actually to have the time to react to where long-term fundamental value is going to be. I mean, in the early days of any crisis where there's significant panic selling, it's hard to actually take the time during the course of the day to do the fundamental work because there's so many unknowns. But now we can kind of get an idea as to what we think how deep the economic recession is likely to be. People can start to model that out as a worst-case scenario, a medium-case scenario, or not quite as bad. So I refer to those as sort of the L recovery, the U recovery, or the V recovery. There will be a recovery in here, and the question is, how far will that recovery be from where people had modeled out, steady state at the end of 2019? And once you start to do that, you can begin to discount the immediate impact of the virus and begin to look beyond into 2021 and 2022 of what those businesses will begin to look like from a cash flow standpoint. And once you start to do that, you can begin to try and ascertain where floor values are going to be in some of the more obvious areas. And obviously, we're seeing that in places like healthcare and technology and stay at home, anything that benefits from staying at home more. Those are starting, are going to be the areas that I think obviously have rallied first and will continue to show resilience in this.
So, Jeff, when the market bottomed, or at least temporarily back in late March 23rd, I believe, there was this desperate need for cash among companies. They were just trying to access cash any way they could. We know that parts of the Fed's different programs that they've launched will take a while to get going, like the commercial paper program, for instance. But has it calmed nerves to the point where your corporate clients can access the cash that they need in a timely manner on manageable terms? Do you still see this desperate rush for cash the way we did at the end of March 2-3 weeks ago?
So I think that's two different things there. One is immediate cash to meet much more immediate challenges like making payroll versus long-term, am I financed correctly to withstand a prolonged economic turndown, or in my top line might be significantly lower than what I originally budgeted. And so as it relates to the first one, a lot of companies drew on their revolvers. A lot of our clients, certainly our private equity clients, portfolio companies, they know the first thing you do in a time of uncertainty is you hit your revolver and you try to get as much cash in your own hands as you possibly can. And certainly in the early days, the first week of March, maybe the second week of March, there was a lot of drain of liquidity in markets. And the Fed acted very, very quickly to pulling out a lot of the stops that or a lot of the programs that we saw post the global financial crisis to get that to get liquidity back into functioning markets, which I think was a huge relief. People didn't have to worry about whether or not they were going to have cash tomorrow, and that was, I think, a huge relief across the entire platform. That's part of what drove, I think, the rallies towards the back half of the month, is that people felt like they could see that there wasn't going to be an immediate cash crunch. Now, as we progress beyond this, people are taking a look at and modeling out how they're going to be able to access these programs, particularly the smaller businesses. The last week was really about focusing in on the mechanism of transmission. So, if you have a banking relationship, are you going to be able to go to your bank and if you are an existing borrower and get funds from some of these programs? And I think what you're seeing is the demand for those programs probably outstrips the original allocation for things like PPP and the SBA and the small business loans. And that's why you're hearing today, Secretary Mnuchin and maybe Senate Majority Leader McConnell coming back and saying, okay, we're going to add to that program or add additional funds into that program, because my sense is that the demand for that was greater than what they originally allocated. And I view that largely as positive, because this is all geared towards bridging individuals and companies, particularly small companies that make up about 50% of the employment in this country. It's about bridging them until we can start to turn the economy back on again, and consumers feel like it's safe to go back and begin to start having more regular consumer behavior, post when the lockdowns are really lifted.
Yeah, good point, Jeff. Given your background in deal making, Jeff, I'm curious, what's your outlook in general for M&A activity going forward once we get through this period that we're in?
So I think it's really a tale of two cities. If you were already pretty much locked and loaded on getting deals done, I think they probably get done, particularly in some of the larger mergers. If they're just waiting for regulatory approval and they get done, I think they probably end up happening. Certainly the ones that we think were just between signing and closing and not really financing dependent are in really good shape. I think the challenge for the M&A pipeline is really what happens if you were about to launch a process. And I would say in that particular case, people are going to take a wait and see, because the buyers are still the potential buyers for these, both strategic and financial buyers, are looking at their existing portfolios to assess the damage. And if they've got excess capital or capital on call, in the case of private equity, they're going to be maybe required to put more equity into their existing portfolios. So even if you were to launch a process today, the likelihood is that you're launching it into a marketplace that isn't ready to accept new ideas. So that probably clears up over the course of the next quarter and or so. And so I think from our standpoint, we look at the sellers. Are the sellers still willing to be sellers? Have they readjusted their sights on valuation? Probably. And then it just becomes a matter of getting the buy side to reengage as they see opportunities. And what I will say is there is a lot of money being raised, particularly for distressed credits and distressed lending opportunities. I think those very large players, particularly in the credit space, have access to pools of capital. And what I've heard more recently over the last 2 weeks is that they've been successful at tapping into some of the global asset allocators to really take advantage of this dislocation. A lot of folks have been keeping cash around waiting for something like this. And so I think you'll see that start to play out over the course of the next few quarters.